Welcome to Wall Street Confidential. I'm Farnoosh Torabi. We're revisiting Under Armour with Jim Cramer. The stock today getting an upgrade from Citigroup. The analyst there saying he's not as concerned about inventory. We know that inventory was up more than 100% in the third quarter. They overestimated the weather. Now, last time we spoke, you were also concerned about inventory. Are you over it?
Well, I had a good discussion on Friday with Eric Wiseman, the unbelievably good CEO who runs VF Corp, which is North Face and Jansport, Wrangler, Eastpak, Kipling, Reef. I mean, a lot of really good brands. And one of the things he told me was that, look, the markdowns for his product have been not that bad. Which is, he had some markdowns, but markdowns are the key thing. And the issue of how do you figure out whether markdowns is whether you have a lot of inventory. Under Armour has a lot of inventory, or had a lot of inventory. I think it's a risky call. Let me tell you why. VF Corp said things were better than expected, and the stock was at 67. And then the stock goes to 63, and then they report the upside surprise. And all you do is get back to the 67 and then some. Now, 63 to 70, which is where it is right now, is a pretty good move. That's 7-point move. But that's the single best story out there, and that's all you picked. And you had a 3.5% yield at 63. So that has tremendous valuation underpinnings. Think about all the things that went right with VF. Tremendous valuation underpinnings, great dividend, tremendous management, good brands, going to 50% international. Under Armour is very domestic. And yet it still couldn't really ramp. In the meantime, Ralph Lauren down again. So I just think the group is too hard. Sometimes, like I was saying on Friday, VF is the best stock in a bad neighborhood. Sometimes I just say pass. I mean, Under Armour, I don't know what data reports.
Later this month.
But, Under Armour is just one of those situations where it's just very, very risky. Let's analogize to another business, Salesforce.com. I think Salesforce.com is having a great quarter CRM. I would probably be a buyer of the deep in the money calls and maybe sell common over it. But I mean that is a situation that I have tremendous confidence in. Yet I'm still listening. I'm still not willing to own common. So Under Armour is just a very, very dicey call that I'm afraid to recommend.
One thesis supporting Under Armour, some analysts cite that, okay, they don't really follow trend. What they make is something that you can wear all year round. It doesn't follow the fashion.
But that's not been the case. It's been the case that when it's cold, people buy more Under Armour than when it's not. And I appreciate them saying it, but it's not held up. Dick's is an interesting story in that that's come down a lot and no one seems to be interested. Nike is down from 66 to 60. The last quarter was good, and we're heading into the Chinese Olympics. And I'd rather own Nike at 60 than I would Under Armour here. But again, this is just a really, really tough group, like restaurants. I mean, look at Liz Claiborne, never bottoms. Jones Apparel, JMY, it's got a 5% yield. No one cares, and a buyback. So these are Pyrrhic. You could be very right, and it still might not make you money.
Okay, a dicey call, the VMware upgrade. Thanks so much, Jim Cramer. This is Wall Street Confidential, only on TheStreet.com TV. Stay tuned.